Hello, everyone, and welcome back to the J22 Report. I am your host, Johnnie Market. Y'all know that drill. Hit that like button, subscribe if you already haven't. And I was going to do today's stuff, something big news today, so I just wanted to go over it. Uh, anyway, first I'll do the economic data. Retail sales below consensus, but a 4% rise. Consensus was 6%. As you can see, but nothing big. Initial jobless claims, 217. That's more than a consensus. Fed manufacturing, 44.3, which is a contraction. Like, there wasn't anything, but one thing that really got me, and we talk about the housing market on this channel and how it's gonna tank over the next couple of years. But if you look at it right here, I was looking at this. This is the NAHB, which is in contraction. You can see it increased to 47, but 30% of the builders cut home prices in January. Share stable, but they're cutting prices, the home builders, and it says the average price reduction was 5% in January. Same rate as December, but the use of sales incentives is 61%. And that's been since June. So you can tell Americans that can't afford homes, they're doing all the incentives, everything. And if you look at this, just really not just like ooh, it's not that good. So see, and one thing I want to go into, and this is how you can tell the Fed is really going to cut rates. And I think real rates will rise, but the Fed funds rate will decline. Mortgage interest rates top 7%, hitting 7, but here's what they say. Relief will be in sight. And of course, the Fed has started cutting rates. And if you look at it here, this is why they think relief was in sight. They talk about this soft landing now. It's back in the news. Fed may cut rates sooner and faster than expected if disinflation tends to hold. And this is what they're doing. Disinflation is likely to continue to ease and possible allow. If they do cut rates, inflation will be back on the rise. That's what I've been saying in this channel. They know it. That's why they're bringing in the Trump tariffs. But inflation's getting close to 2%. Of course, we know the real rates like much higher. Here it is. Rates happen in the first half. They're optimistic disinflationary. Trends will continue. So they want to restart several rate cuts several months from now. So here it is. I think they'll cut rates. They're going to do every excuse. But when it comes to mortgage rates, all I have to say is remember the past, because here's what I typed. I just Googled this. Lower mortgage rates are coming in 2024. And they said National Association of Home Builders expect 30-year mortgage rates to decrease to 6.5% by the end of 2024 and below 6% to 2025. Well, where are the mortgage rates? They are at 7%. So they were wrong. And we can even go back and let's go back to the share. I didn't want to show how wrong they were. Don't believe me. This is a recent article. Mortgage rates top 7%. This was January 16th, 2025. But what they were telling you in 2023, mortgage rates will go to 6.5 by the end of 2024, which they were wrong, and below 6% in 2025. Now, this is possible, but I don't think so. And that's the thing. Interest rates on the long end are in a bull market. Eventually, it's going to hit the stock market, but we went over this. A lot of that when the Fed started raising rates in 2021 or 2022, they locked a lot of their long-term debt up. A lot of them, they took advantage of those 0% interest rates and they locked in their debt for 5, 6, 7 years on a long-term basis. And that's why the Fed got to go ahead to raise rates because then they can just earn their debt wasn't going to increase much and they could earn money on their cash back. The only thing is the lower end consumer really got hit with that. And a lot of other people are going to get hit with that continue, and you're going to see businesses start to crumble. And the Fed sees that. And not only that, a lot of commercial real estate, if you've been watching this video, they have to refinance this year. And that's why the Fed's going to cut rates. They're trying to do everything they can to save it, but it's not going to save it. So, anyway, that's all I have to say. In terms of gold was up today, miners were not. And as I said, I think the miners are going to go on another leg up. I think it's going to come in a couple of months when the earnings, when these cash flow at 2,700. You have to remember, this time last year, gold was around 2,000. So we haven't had those multiple earnings. And it didn't really start moving until January or till February of last year. And then there was a little break. So a couple more quarters, they're going to start seeing much stronger balance sheets. They're going to see much stronger balance sheets, much better cash flows. So I think that's what's going to happen. They're going to pay a lot of that down. Nothing else on it, really, any other market. I like energy actually, but that's all I have to say. Just remember, nothing said on this channel should be construed as investment advice, just my opinions, my thoughts on the markets, and I will talk to you later.